So let's talk about one of the most popular ETFs out there, the Schwab US Dividend Equity ETF, or as pretty much everyone calls it, SCHD. It's become a huge favorite for a lot of investors, and today we're going to dig into exactly why that is.
Now, that's a pretty bold statement, right? But honestly, it gets right to the heart of what makes this ETF tick. See, SCHD isn't just another run-of-the-mill fund. It has a really unique design, a special kind of engine under the hood. And in this explainer, we're going to pull back that curtain and show you exactly what makes this dividend powerhouse run.
All right, so here's how we're going to break it all down. First, we'll cover the basics. What is SCHD? Then we'll look at its automatic investment engine, which is really cool. After that, we'll see how it stacks up against the competition, look at its performance, the good and the bad, and then dive into its long-term power and, of course, the risks. Finally, we'll give you our final verdict.
All right, Section 1. What exactly is SCHD? Well, on the surface, it's an ETF that tracks the Dow Jones U.S. Dividend 100 Index. But it's so much more than that. Let's look at a few key numbers that really show you why this thing has become such a giant.
First up, just look at the sheer scale of this thing. We're talking about roughly 84 times billion dollars in assets under management. I mean, to put that into perspective, that's bigger than the entire economy of some countries. So yeah, this is not some small niche fund. This is a real heavyweight, trusted by a ton of investors.
And then there's the cost. The expense ratio is just 0.06%. That is incredibly low. And look, this is a huge deal for anyone investing for the long term because fees, man, they can just eat away at your returns. With SCHD, almost all of your money is actually working for you, not just paying some fund manager.
Okay, and this is a big one for a lot of people, the dividend yield. It's sitting at around 3.5%. Now, that might not sound like a crazy high number, but it's way higher than a lot of its competitors. For example, if you look at VIG, another popular dividend ETF, its yield is only about 1.6%. So right from the start, SCHD is designed to give you meaningful income. But hey, it's not just about the income, right? The 10-year total return has been a very impressive 10.8% on average. And that's the compound annual growth rate, which is just a fancy way of saying what your return would have been smoothed out each year. The bottom line? SCHD hasn't just been handing out dividends, it's been growing in value too.
So when you put it all together, you see that SCHD isn't a one-trick pony. It's got this kind of triple engine driving it. It looks for quality companies, it gives you a high yield right now, and it aims for strong dividend growth in the future. It's that unique blend of all three that really sets it apart from everything else.
Okay, so now for the really fascinating part. Let's talk about the secret sauce, right? The real magic of SCHD is in how it picks its stocks. It has this automatic engine, and this is what truly separates it from the rest of the pack.
So the index it follows has this super strict four-part checklist. First, it checks for a strong cash flow to debt ratio. Basically, is the company financially healthy? Second, it looks for a high return on equity, or ROE, which is a great sign of a well-run, profitable business. Third, of course, it has to have a good dividend yield. And fourth, it has to have a solid 5-year track record of growing that dividend. Only the top 100 companies that check all of those boxes get in.
And what's the result of all this? Well, it's pretty brilliant, actually. It creates this kind of automatic buy low, sell high system. Think about it. When a great company's stock price drops, its dividend yield goes up, right? That makes it look more attractive to the index. On the flip side, when a stock has a huge run-up, its yield gets smaller, and it's more likely to get trimmed or sold at the next rebalance. It's a system that forces discipline and takes emotion completely out of the equation.
Okay, so we have this disciplined strategy. How does it actually stack up against the competition? Let's put it head-to-head with some of the other big names out there and see what we find.
And this is where you can really see how SCHD carves out its own unique space. You've got VIG over here, which is all about dividend growth, but its current yield is pretty low. Then you have UIM, which has a nice high yield, but its growth isn't as strong. SCHD, it's like it takes the best of both. It has that high yield like VYM, but its dividend growth is actually faster than VIG's. And on top of all that, it's had the best total return over the last 10 years. It's not just a mix. It's like it was designed to be the best of all worlds.
But, and this is really important to understand, that performance doesn't just go straight up in a perfect line. Not at all. SCHD can be cyclical, and its annual rebalancing can really shake things up and affect how it performs in the short term. Yeah, this timeline tells the story perfectly.
Take 2021 and 2025. The market shifted towards value and energy stocks, and SCHD was perfectly set up to crush it. But then look at 2022, when interest rates were being hiked like crazy, or 2023, with that massive AI and tech rally. In those environments, SCHD's value approach made it fall behind. So you see, this up and down cycle, it's really just the price you pay for its long-term strategy.
And that March 2026 rebalance is just a fantastic example of that buy low, sell high engine in action. It took profits on energy stocks like Valero and Halliburton after they had a huge run. And what did it do with the cash? It bought into high-quality companies in healthcare and tech that had been beaten down, like United Health and Accenture. And this is why it matters. It shows the fund is always automatically hunting for value, trying to upgrade its portfolio for the future. It's that discipline of taking profits and reinvesting in new opportunities that really pays off in the long run.
So let's put it all together. What does this mean if you're a long-term investor? Well, let's talk about the absolutely incredible power of compounding, but let's also be really clear about the risks you need to watch out for.
Okay, now this is where it gets really exciting. Because of that high starting yield and that fast dividend growth, when you reinvest your dividends, the drip strategy, it creates this insane snowball effect. Just look at this chart. You can see how the income from SCHD just starts to pull away and then dramatically pulls away from both VIG and VYM over time. And here is the punchline. After 30 years of that compounding magic, that initial $100,000 investment could be generating over $62,000 in income every single year. That is just staggering. It's the power of this compounding machine at work.
But of course, it's not all sunshine and rainbows. There are real risks here we have to talk about. First, that rebalancing can mean it sells its winners too early, especially when certain stocks are just ripping higher. The turnover is pretty high, which isn't great for taxes if you hold it in a regular brokerage account. It's also more concentrated with only about 100 stocks. And finally, there's the value trap risk. This is where a stock looks cheap for a reason, because the business is actually in trouble. Think of a company like Pfizer, for instance. Its stock price might drop, making its yield look attractive, but if the company's facing real long-term problems, then it's not a bargain, it's a trap. And that's a risk you always face with this kind of value strategy.
All right, so we've looked under the hood at the engine. We've analyzed the performance, we've seen the incredible long-term power, and we've been honest about the risks. So now, let's bring it all home. Who is this ETF actually for?
So who should really be looking at SCHD? Well, if you're a long-term wealth builder who wants that strong total return, it's a great fit. If you're an investor who wants both income today and growth for tomorrow, it's pretty much perfect. And honestly, if you're planning to use a DRIP strategy inside a tax-free account like a Roth IRA, it's hard to argue there's a better choice.
And that really brings us to our final verdict. SCHD isn't just another dividend ETF. It's something different. Thanks to its unique, super disciplined system, it has created what is quite possibly the most powerful long-term income compounding machine you can find in a single investment.
And of course, just a quick reminder, this is all for educational purposes. It's not financial advice. Past performance is no guarantee of future results, and you should always talk to a qualified financial advisor to figure out what's right for your own personal situation.